Hello everyone, thanks for checking out my video. The S&P 500 and Nasdaq surged to fresh record highs last Friday as the latest jobs data suggested that the labour market remains in good health, but not strong enough to raise immediate worries about inflation. As a result, the market rallied. The S&P 500 is now on track to close the year with a gain of around 28% after setting 57 record highs this year. I wouldn't be surprised if we hit 60 all-time highs by 31st December. At the moment, the Wall Street is partying like it's 1998 as market optimism fuels gains unmatched since the 2000 dot-com bubble. This bullish market momentum is so strong to a point where it seems like nothing will disrupt it. Well, is that really the case? Let's discuss them in this video. Do watch on till the end to find out more on my thoughts. Alright, so the US stocks mostly rose last Friday as investors digested November's jobs report, a crucial data ahead of the next Federal Reserve meeting taking place on 17 and 18 December. Both S&P 500 and tech-heavy Nasdaq clinched their third straight winning week as they touched new all-time highs during the session and closed at record highs. The gains were mainly driven by big tech names such as Tesla, Meta, and Amazon as they either hit a new 52-week high or a fresh all-time high. The latest rally came after November's jobs report, released last Friday before the market opened, showed that non-farm payrolls increased by 227,000. This is above the expectation of 214,000. The unemployment rate came in at 4.2%, in line with market expectation. This overall not too hot and not too cold report suggested that the labour market remains solid enough to keep the US economy going, but not so strong to the extent that it deters the Federal Reserve from cutting rates again later this month. Okay, if last Friday's jobs report likely kept the Federal Reserve on track to cut interest rates this month, the upcoming week's inflation data is perhaps the final key data point that could potentially alter that narrative. The Wall Street needs to pass this inflation check before we can confidently say that the Fed is gonna further cut interest rate this month and that we are getting closer and closer towards a soft landing. This coming Wednesday 11 December, the latest consumer price index will be released. This data will offer another glimpse into whether inflation remains stubborn and sticky. If the figure surprises to the upside, it might pressure the Federal Reserve to pause their interest rate cut campaign. And I think the market might not like it. On top of CPI, we have another inflation indicator releasing this coming week, and that is the Producer Price Index, set to be out on Thursday 12 December. But I think this shouldn't move the market as much as CPI could. On a side note, the earnings season is drawing to a close, with a few more big names reporting this week. Notable ones are Broadcom, Costco, and Oracle. And for those who are interested in meme stocks, which I don't encourage, you might be interested in GameStop's earnings. Moving over to the technical analysis section, in my previous video I shared that above 604 there are two resistance levels to watch, which are 609 and 616. I also mentioned that sellers may step in around 604 or 609. Well, I guess sellers did step in last week as SPY hit 609 level. Come this week, watch this 609 as a resistance level again. If SPY can close above it, then there is a likelihood that SPY may grind towards 616. But given that RSI indicator is approaching overbought zone, I think it's quite unlikely for SPY to go beyond 616 this week. In fact, it might not even hit 616 actually. Well, I could be wrong. On the other hand, if SPY gets rejected at 609, watch for 604 and 600 as the support levels. If the market wants to retrace, 604 will likely not hold. The more important level to watch is actually 600. Other than acting as a psychological support level, it is also where the first Fibonacci retracement support level is. If this breaks, or in other words below 600, watch for 588. This is where the 50% Fibonacci retracement level is, which often serves as a common rebound level. If we are going to have a center rally this year, then 588 shouldn't break. If we ever go near this 588 level in the next 1 or 2 weeks, it could present an opportunity to either add on to your long-term positions or enter a short-term bullish trade to ride the rebound up with stop loss in place. Let's move over to Apple. Apple is on this steep monster run since it reported its last earnings on 31st October. At the moment, Apple looks a little heated up as the RSI reached the overbought level. For the last few occasions when the RSI went near to the current level, it was usually followed by a retracement. Therefore, I wouldn't be surprised if Apple continues to ride on last Friday's small pullback and continues to retrace this week. If it indeed happens, watch for 239 as the first support level, where the first Fibonacci retracement level sits, but this level is not that crucial in my opinion. I personally will watch for the blue support line. This level is around 236, which used to be a resistance level but has now turned into support. If this 236 level breaks, I think it might open the floodgate towards the 50% Fibonacci retracement level at around 232. Similarly to SPY, if nothing unexpected happens, such as an upside surprise in the CPI data, then by right, Apple should not break this 232 level entering 2025. On the other hand, if Apple somehow manages to continue its climb up, then it may bounce from the first Fibonacci level at 239 or perhaps even the current level. Above 244, or if it sets another new record high this week, then it will be the case which I always said, the sky is the limit at such uncharted territory. Let's now jump over to Tesla. Tesla looks really unstoppable right now. Look at the chart. From the low of 212 in October this year to the recent high of 389, that's a whopping 83% surge. Along the way, it has broken above a few 52-week highs, which had acted as a resistance level in the past. Not just that, the MACD has turned bullish again, something that I mentioned in my previous video, which was if the MACD has a bullish cross again, Tesla could fly. When I make this remark, Tesla was at 340's range, and I even mentioned that flying from 345 to 365, that's a good $20 jump. Little did I expect Tesla would jump another $20 to hit 380's range. Amazing. Anyway, for this week, we might have a little more room to go up, basically hitting 390's range or go near 400 before resistance comes in. Nothing too technical to explain for this potential move towards 390s or 400, as I believe it is purely a sentiment-driven rally right now. FOMO buyers were stepping in and will continue to step in, so I wouldn't be surprised that the bulls will want to bring it to the huge 400 level. At 400 level, just like the few other resistance levels that Tesla has previously broken above, basically if it can close above this landmark level with solid green candles, it could open the door to much more upside. In a way, yes, there's still some technical element to this, which is when key or heavy resistance levels break, the stock usually flies. On the other hand, watch for potential rejection at 390s to 400 level with the RSI hitting overbought level soon. We might have a bearish divergence on the RSI. Note the word might. It all depends on how the stock moves early into the week. If RSI starts moving downwards, then the bearish divergence could play out. Just one more thing to highlight, the latest candlestick is almost falling out of the Bollinger Band. Whenever this happens, it typically means there could be a bit of retracement or at least a sideways movement shortly after. Again, watch the movement on Monday and Tuesday. We could do a pop and fade movement. By the way, not trying to scare you, if Tesla really wants to fall, if the big whales unload their shares to take profits, don't blink your eyes because we could easily see Tesla in the 350s and 340s range again. So if you're in some short-term bullish trades right now, there's no harm taking some profits off the table. Not financial advice, of course. Looking at the weeks ahead, or to be more precise, before Tesla announces its quarterly and 2024 overall deliveries in early January, I wouldn't be too concerned even if Tesla dropped to 320s or 300 level, where the 38.2 and 50% Fibonacci levels are. I know it may sound very crazy, but I'm not saying it will happen. In fact, I do think the odds are low. What I'm trying to say here is that do stay calm if Tesla ever falls to those levels this month. Let's now check out Google's chart. Google looks a little bullish to me. Ever since it bounced off the strong support of 200 moving average, it has been creating higher lows, and that's a positive sign. Another positive sign and potential bullish signal is that the MACD is about to cross back up. For this coming week, if Google can stay above 174 resistance turn support level and with MACD crosses up, we have a chance to head towards 180 or even test the recent high of 182. For Google to be really bullish, it needs to break above 182, which has proven to be a level of resistance as Google got rejected twice previously. Will the third time be the charm? Let's say Google gets rejected again at 182, it doesn't matter, we are fine as long as Google stays above 174 support level. It is only when 174 breaks, then Google may potentially head towards the 50 and 200 moving averages again, at 169 and 164 respectively. Interestingly, both levels coincide with the 38.2 and 50% Fibonacci levels. If we were to have a center rally this year, I think the odds of Google falling below both levels are low. But if we ever pull back to either levels, especially the 200 moving average, I will be looking at selling cash secure put, something that I missed when it kissed this moving average in late November. I was a little greedy back then as I wanted to see if Google will fall below the 200 moving average for a while before bouncing up. But the next thing I knew, Google briefly kissed it and rebounded strongly. Anyway, this again validates what I have been sharing, and that is this 200 moving average is a super strong support for Google. Okay, let's now have a look at Meta's chart. So in my last video, I shared that if we have a bullish cross on the MACD with Meta going above the downtrend channel, we could easily hit 590s or even go close to 600. Well, Meta did more than I expect by hitting a new all-time high in the 620s range. In terms of the bullish thesis, the next resistance level is at 635 followed by 657, which you probably can't see on the screen. Well, given the RSI is hitting the overbought level, I believe it's quite difficult for Meta to go above 635 resistance level this week. Anyway, between the current level and around 630s range, we could see sellers stepping in to take some profits. Again, I could be wrong, and who knows, Meta may fly towards the second resistance level of 657. Let's see. On the other hand, if sellers indeed step in this week, watch for the first Fibonacci retracement level at around 598. Or maybe we give it a range, say 598 to 600, because 600 is a psychological support level. If Meta falls below this 598 to 600 area, then we are entering this consolidation zone that ranges from 546 to 598, which means don't be surprised if Meta drops to 570s or even 560s range to retest those Fibonacci levels you see on the screen, as well as the blue downtrend channel. Any retracement and rebound from these levels would give Meta a chance to cool off the indicators before it flies again for a year-end center rally. But of course, if Meta falls back into that downtrend channel, then we can say that the short-term trend has turned bearish. Okay, let's move over to Microsoft. Well, 9 green candlesticks in the last 10 trading days. I guess I don't have to tell you that Microsoft is bullish. Furthermore, I have been saying that if Microsoft goes above the blue dotted uptrend line, it is bullish. And so, Microsoft did it last week with solid green candlesticks. For this week, similar to a few other stocks that I covered, Microsoft RSI is approaching overbought soon. With this, I wouldn't be surprised if we have a retracement to retest the blue trend line. So long as Microsoft stays above that trend line, it is still bullish, as simple as that. In fact, if it retraces, retests that trend line and rebounds, that's even more bullish. When that happens, we could go above the recent high of 446. On the other hand, if it falls below the trend line and goes below the 23.6 Fibonacci level at 436, then it means that the bulls are losing strength. But to me, it is not that bearish yet. It is only when Microsoft falls below 425, then I would call the short-term trend bearish. The last line of defense for the short term lies at 420, where the 50, 100 and 200 moving averages are. If we ever get to this level this December, I will likely step in to sell a put option, which is a slightly bullish move, because I believe this is one damn strong support level. But of course, the risk is if this level breaks, then it's waterfall time. Moving over to Nvidia. Nvidia looks pretty interesting to me. The rest of the mega cap stocks that I covered all display decent bullish momentum, but for Nvidia, it's a little opposite. I know it takes a lot to go against this hottest stock in town, but I am being objective here and merely reading off the chart. So what I can see on the chart is that Nvidia fell below that green uptrend line, attempted to retest it last week but got rejected. It might attempt to test it again this week. If it continues to fail the retest, watch for 138 as the support level. That's a level formed by the 50 moving average and the first Fibonacci retracement level. A rebound off this 138 level would be good, but if it doesn't, honestly don't be surprised if Nvidia gets below 130 and hit the 120s range pretty quickly. At 120s range, watch for 121 as a potential bounce level. Once again, if it doesn't bounce from this 121 level, I would say Nvidia's short-term trend has turned bearish. The last line of defense lies at 114, which is formed by the 200 moving average as well as the critical 61.8 Fibonacci level. This level must not break. I repeat, this is one level that the bulls have to defend at all costs from now till the year end. On the other hand, yes, the chart may look a little bearish at the moment, but things can change every single week and single day. So in terms of the bullish thesis, if Nvidia can stay above the 50 moving average and best still goes above the green trend line, then the stock could fly. When I say fly, I am talking about 150 at least, or perhaps even a new record high. Let's now cover my options trades. The first trade to update is this new Tesla cash secure put that I sold last Friday, 6 December, with a strike price of $2.95, and the contract will expire on 17 January 2025. The reason for selling this put contract, a slightly bullish move, is because Tesla's bullish momentum is way too strong. It's almost in a melt-up stage. I mean, as shared earlier, Tesla basically looks unstoppable at the moment, as it broke above a few key resistance levels, and the MACD just had a bullish cross last Friday. As mentioned in my last video, when the MACD crosses back up, Tesla could fly, and boy, it really did, as it went close to 390 last Friday. I wouldn't be surprised if Tesla starts hitting the psychological level of 400 as more FOMO investors pile their money into the stock. All that said, to safeguard my trade, or rather to manage my risk in case my thesis is wrong, I chose a strike price that is below the strong psychological support level of 300. Coincidentally, 300 is also where the 50% Fibonacci level is, which is a common level for the stock to rebound. Anyway, within a day of executing the trade, it is up by 15% already. I will let the trade run a little longer and see how it goes. Okay, the second trade to update is this cash secure put on Tesla that expired last Friday, 6 December. This contract was sold on 25th October when Tesla was trading in the 250s to 260s range. The strike price for this contract was 220. When I sold this contract that time, there wasn't much technical analysis behind it. It was a momentum play where I aimed to ride on the strong bullish momentum back then. What happened was, Tesla popped more than 20% on 24th October after its earnings report, and the rally continued into the second day, 25th October. This clearly showed that a lot of FOMO investors were stepping in to chase the share price. More information about this trade can be found in the video linked at the top. But honestly, little did I expect that back then was just the beginning of this whole monster run. Since the day I sold my put contract, Tesla went on to rally more than 40%, and my 220 strike price was never close to getting breached. So, as per many of my other options trades, this contract expired worthless last Friday and I got to keep the full premium of $350 without having to close my position. This premium is actually quite juicy in my opinion, as it's about 470 Singapore dollars, adding on to my monthly option side income. By the way, if you are new to options trading, do check out my free options videos. Alright, the final update is on this trade that didn't go as planned. As I have mentioned before, I aim to be transparent by sharing not only the successful trades, but also the options real trades that didn't work out. If you have been following this channel, you would probably remember this covered call on Google that I have been rolling since a year ago. The last time round that I wrote this contract was in July this year, where I wrote it till this month December. The strike price was 130. Well, Google is clearly way above 130 now, and in order to prevent my shares from getting caught away, I have rolled it again to 16 May 2025 with a new strike price of 135. In case you're not aware, the cost price for this Google shares is $100. So whether they get caught away at 130 or 135, I will still profit from the trade. Just that Google is trading at 170s range right now, and if I allow the shares to get caught away, I will miss out on the additional upside and profits. Meanwhile, if you are curious, here are the number of times that I have wrote and premiums that I have paid for this trade. The trading fees incurred so far is around $30+ US, and whenever I wrote a contract, I tried to roll it with a credit, factoring in all these trading fees. So if somehow this contract expires worthless in May 2025, I will gain a small profit from this multiple rolling of the trade. Alright, sharing some of my thoughts. To start this section off, let's answer the question that was posted at the start of this video. Is the current bullish market momentum so strong that nothing can or will disrupt it? The answer is a firm no, just not yet. Here's another question. Is this perceived overvalued market going to have a huge pullback? The answer is yes. And again, maybe just not yet. Okay, let me explain a little bit more. First of all, the latest jobs report offers positive sign as it kind of matches and adds on to the thesis of a soft landing and Goldilocks scenarios. To put it in simple terms, it means decent economic growth, stable inflation, and robust labor market. Based on the various economic reports released for this year, the inflation, though sticky, is trending downwards. The jobs market, though softening, but it's not weak and remain robust. The US economy is pretty healthy as well. And if this coming week's CPI figure doesn't kill the holiday spirit, then I think the market could rally into early 2025. This is why I think the market rally is unlikely to be disrupted just yet. However, going back to the earlier questions, I personally believe that this rally would eventually be disrupted and a bigger than usual pullback would come. It's a matter of when, not if. Because if you dive in deeper for some of the economic reports, there are some underlying threats. For instance, sticky housing, shelter, and wage inflation may complicate the Fed's efforts to lower inflation further in the short term. To put this in simple terms, bringing inflation down from 8 to 9% to around 3% may not be too difficult, but from 3% to the Fed's target of 2%, it's gonna be a little bit tough and bumpy. Apart from economic reports, the market is also rallying based on Trump's victory. Whether you believe it or whether you like it or not, Trump is still a wildcard after all. A lot of optimism has been baked into his victory, and when he starts taking charge in January 2025, we really don't know what will happen in terms of his policies and how will the market react to them. Okay, all those that I have just shared are on the macro environment. In terms of technical perspective, the VIX index, which measures the expected volatility of S&P 500 over the coming 30-day period by looking at options data, is trading near its 6-month low. And in case you're not aware, VIX is also known as the fear index. So with VIX trading at such low level, it's kind of indicating that there is little to no fear in the market right now. Well, for sure it can go further down from this point, but the more it drops from here, the more wary I get. Because when VIX spikes, it can run up really fast. And that's when usually there is a sell-off in the market. Also, don't forget this phrase, be fearful when others are greedy. That being said, there is no need to waste too much of your time to anticipate when is the next huge pullback. Just follow the old saying, the trend is your friend until it bends. Right now, the trend is obviously very bullish, and when it bends or starts to bend, I will be updating you guys here on my channel. So do stay subscribed to keep yourself updated, and don't forget to like this video if you found my content useful. Thank you.